Welcome. My name is Jude Hadi, and I am a second year at Columbia Business School. I'm graduating in May, so class of 23, which is kind of exciting, kind of scary, but here we are. And it's my pleasure to introduce the moderator and the speakers for the alumni panel, Investing in Uncertain and Volatile Times. Moderating this session is Meghan Cross, class of 2015. She is currently a partner at Amplifyher Ventures. And then we have two lovely speakers. We have Dewey-Golob, class of 95, and she is the co-owner and founder of PhotoBall and an angel and venture investor. And we also have Laya Khadjavi, class of 88, and she is the global head of business development and client relations at Menai Financial Group. With that, I'd like to hand it over to Meghan and enjoy the session.
Thank you so much, and thank you for having us here today. It's great to be back on campus. It's a brand new campus here. I'm Meghan Cross, partner at Amplifyher Ventures. We are a seed stage venture fund based here in the New York area, investing into early stage companies founded or led by exceptional women and diverse leadership teams. I'm very honored to be here today, really having free reign to ask these exceptional women a whole load of questions for the next little while here. But before we dive in, I'd love it if you could each introduce yourselves and really, share your career trajectories to date. Inger, do you want to start us off?
Great. So I'm Inger Dewey-Golob. I graduated from Columbia in 1995 with a degree in finance. Right after business school, I went to work on Wall Street for David Londoner, the #1 entertainment and media analyst on Wall Street. And I was able to use a lot of the skills I learned in value investing and security analysis from Columbia as one of the best value investing backgrounds. And I did that for about 5 years, and then I moved to the buy side, where I was continued as an analyst, picked up more of consumer and retail household products, and continued to cover entertainment media first at Wells Capital in San Francisco, and then at Chase Asset Management here in New York. And then I moved to the West Coast, and I left sort of public investing and moved to the private side. I started out as an angel investor, investing independently in some small seed companies. And then when was it? It was 8 years ago, I reconnected with one of my Wall Street buddies who had a seed company of female investors, and she, at that stage in her life, really wanted to be in the C-suite and to run a business. And so she and I together looked at companies that we could potentially acquire and turn around, and we landed on this sports memorabilia company based in Kansas. And we really felt there was an opportunity to change the business model and really bring it online. And so that's what we've done. So I'm a business owner, not just an investor, but I am a business owner. And I think that being a business owner helps you be a better investor. It makes you more empathic. And then more recently, I joined the Astia Angel Group. So I'm one of the Astia Angels, and we look at companies in the healthcare sector, tech sector, consumer, sustainability. And I also invested in Astia's first venture fund because I really wanted to back female venture capitalists investing in female-founded companies. And then I invested more recently as an LP in Accrue Diversity Capital, which equally invests in diverse, so women and people of color founders. And also another thing about Accrue is that they really are broadening their investor base. So their LPs, they're making the investment thresholds a lot lower, so it's more accessible to a broader range of investors. And I think one of the key factors to getting more women funded is to have more women as investors and influencing where the resources and assets are going. So that's my background.
Great. I'm Laya Khadjavi, class of 88. And thank you, Meghan, and thank you, Columbia Business School, for hosting us today. This is actually my first time on this campus, which is beautiful. Just to kind of give you the history of my background, I spent over 30 years actually in traditional finance. And most recently in 2021, I pivoted to the new and brave world of digital finance or decentralized finance and blockchain technology and digital assets. I'll explain to you why I did that. So I started actually my 30-plus year career on Wall Street in 1984 as an analyst at Salomon Brothers in fixed income research. I did that for 2 years, and that was kind of my exposure to capital markets and some of the more innovative stuff on Wall Street, including the beginning of derivatives. I then came to Columbia after 2 years to do my MBA program, and again, I'm really proud of having been a Columbia graduate. This is actually my 35th year reunion at Columbia. And I'm really grateful for Columbia for giving me the opportunity to have this amazing education, but also opening doors in terms of my career path. That what ended me up at my next career, but also making a lot of great and lasting friends and a vast network of people that I've been able to meet both during my 2 years at Columbia as well as afterwards. So after I graduated from Columbia in international finance and banking as my major, I went to Morgan Stanley, and I spent a quarter of a century, and I really date myself, at Morgan Stanley, most of it in the markets business, and focusing mainly on creating some of the more innovative capital market solutions to address both issuers and institutional investors' needs. And spent the bulk of that really in the world of derivatives and structured products. So, innovation, all of that was always something that kind of fascinated me, and I wanted to be part of that. Also ended up running a few large businesses, including structured credit, and then also moved over to wealth management at Morgan Stanley towards my end of my career there, running the markets business. And what was really interesting is that during the late 80s through the first decade of 2000, finance was globalizing. And you saw a lot of innovation across the financial markets. And for me, that was really exciting because I was part of that revolution. And that's what really made my career. So after I left Morgan Stanley, I spent a few years on the buy side working for a credit hedge fund, building their emerging market platform, Ice Canyon, at Canyon Partners, and also started kind of getting more involved on boards, and also started my own kind of consulting business. And it was during mid-2020 when I was actually approached as part of my consulting work by a blockchain technology platform, which wanted to get into the decentralized finance. And they wanted somebody with like solid traditional finance background to come and kind of lay the kind of stage for capital markets and all that. So when I met with the CEO of the company, and I was fascinated, but everything he was talking to me about sounded like a totally different language. And back then I was, obviously I had heard about Bitcoin, blockchain, but I really didn't know what it was. So being the nerd that I am, I said, okay, before I take on this assignment, I need to get educated. So I ended up going to MIT. I took a course in blockchain technology and cryptocurrency and their real life use cases. And it was kind of scary, like after 30 years of not taking a serious course to go to MIT and take this kind of a course. But I did it, I overcame my fears, and frankly, it was one of the best things that I did in my life, which also kind of helped me pivot in terms of my career. And not only I realized that my brain was still functioning at a high level, and I can still get an A from an institution like MIT, but more importantly, it kind of opened my mind to this whole new revolution, which is, finance globalizing was the previous revolution. the internet was the next revolution, and now blockchain technology and digital assets is the next revolution, in the sense that you can take any asset that has value. It doesn't necessarily have to be just money. It can be any financial asset, or it can be any real asset. You can tokenize that and use blockchain technology, decentralized ledger technology, to trade that around the globe without an intermediary or a bank. That is truly revolutionary. And so I got so excited, came out of that course, like trying to, like, obviously helping this blockchain to help them with their DeFi strategy. But serendipitously, I get a call from my old boss and dear friend of 35 years from Morgan Stanley, Zoe Cruz. She was formerly the co-president of Morgan Stanley. She called me up and said, "Hi, what are you doing?" And I'm like, "Oh, Zoe, I just learned about blockchain and crypto, and it's like fascinating." And she said, "Oh, interesting you say that. I just started a new company called Menai Financial Group. And my vision is to institutionalize this new and brave world of blockchain and cryptocurrency by building a platform, an institutional quality platform that gives access to products and services from market making all the way to investment management products to institutional investors." This is an early stage asset class. It's very nascent. It has a lot of hair on it. But this is the future. And why don't you come and join me as the head of global business development? So I did join her in March of 2021, February 21. And together we've been on this journey of building Menai Financial Group. It's been so exciting. I feel the same level of energy and enthusiasm as I had when I was a young associate at Morgan Stanley in the 80s and 90s. And I was part of the old revolution, which was finance globalizing, and now I'm part of this new revolution, which is blockchain technology as a disruptive technology will make a difference in this world. So sorry for that long title.
I have so many more follow-up questions that I'm going to put these aside for now and just continue asking a few more. I'm going to gloss over the fact that you credited MIT with being one of the harder courses taken. But when you say that, this is the revolution, you were part of the previous evolution of the finance industry, what about it do you believe what makes you call something revolutionary in that way?
I mean, I've seen a lot of innovations and ups and downs across my career, and especially in finance. But what I see with blockchain technology, it's very similar to the internet in the sense that it is a disruptive technology. And disruptive technologies do change the world, and they do change existing business models. When you think about it, like the same way that the internet democratized access to information and made it cheaper, faster. And by the way, like back then in the early 2000s, nobody believed in the internet. Like, what is this? And now can we even live without the internet? So parallel to the internet, blockchain technology, again, the fact that you can exchange value, you and I, with a smartphone and access to the internet without an intermediary or a bank, that is really kind of transformative and disruptive. And it's at its first inning. There's a lot still in terms of the growth and maturity of the technology. There are lots of things that need to change. But if you think of it 5 years, 10 years from now, that technology can disrupt so many other business models. It doesn't necessarily mean it's going to replace traditional business model, but it will coexist and complement those.
Augment.
Right.
It's really about the picks and shovels of furthering this. It's interesting that something that jumps out to me about what you've just shared is this unparalleled accessibility that it provides. And if I were to draw a comparison, Inger, your latest career in investing is very much focused on accessibility and the degree to which those who are otherwise untapped and overlooked are receiving investment. And the strategy you have there, namely being investing into women. To what if you could just share a little bit about how you identified that as an investment opportunity for yourself as well. I think it would be interesting to hear a little bit more there.
So why do I want to invest in women? Is that the question?
Well, when you put it that way,
Yeah.
I mean, let me count the reasons, including our own investment thesis at Amplifyher Ventures. But yes, how do you believe that will draw unparalleled value compared to your historical investment?
Well, I think that there were many statistics, and Laya and I had just found this, that there are women-owned businesses generate 1.8 trillion each year, and then 10 times there are 10 times more female entrepreneurs than there were 20 years ago. They also achieve 35% higher ROI than their male counterparts. So I think there are a lot of analytical and numerical reasons why women are the smart people to invest in. And I think the challenge is that women haven't had access to capital. They haven't asked for capital as much. They haven't been introduced to venture capitalists as readily. And even when they get into the decision-making process, they often don't receive the funds. So I think we need to do a lot more to get women into venture capital, get women into starting seed financing, even private equity, so that we see that there are more female founders getting funded. And I think that and I just believe in it. And I think that as a woman, we owe it to ourselves to continue to back women. Yep.
I mean, completely agree. One of the reasons why we launched Amplifyher Ventures is because 2 to 3% of VC dollars every year go to female-founded businesses, right? And when you compare that to, in the venture landscape, some studies show that they generate more than 60% greater ROI to the seed stage investors into those companies. So when you compare those numbers side by side, I mean, here we are at CVS, so I could talk about value investing all day. It seems like a logical value investment strategy, unfortunately, right? But that's why we're here to level that playing field and elevate it in doing so. And women are 2 times more likely to invest into other women. So as you said before, getting more women onto those cap tables and into those allocator roles will drive that forward.
Yeah, and I also think that women, a lot of seed founders, they need mentoring. And I think that's someplace where, as a business owner, I've been able to do that. You're often asked as an angel investor to serve on the board of a company, and they really need to feel like they can let it all hang out, like they can really come to their investors and to their board members with what their concerns are, that they feel that there's a real trust there. And I think that's where the greatest development and growth occurs as a CEO, is if you can really, and I find that now as in the PhotoBall business, I had to take my investor hat off and really start thinking like an owner to allow the CEO and give her the freedom to come to me with challenges. Like, we made a recent hire and the hire is not going well, and this is somebody who's going to be our CRO. And I think that there needs to be really open communication and support, and for yourself to put yourself in the shoes of a CEO who's running a business, a small business particularly, because they're probably wearing multiple hats, like serving as CEO or CFO. So that's something that I've really enjoyed doing.
Great.
Can I make a comment on access and women-owned businesses? We're obviously a women-founded company, Menai Financial Group by Zoe Cruz, and it's majority-owned by women as well. And one of her vision for building this company, she spent 40 years in traditional finance, but she also got involved in blockchain technology, and became a convert, not necessarily because she was going to become a billionaire overnight, because a lot of people actually did that. And we saw some of what happened last year to some of them. But her vision was really to give access, this whole idea of giving access through blockchain technology to the world. It was a big driver of her kind of ambition to build this company. When you think of it, and she always quotes that, there are about close to 50% of people living on Earth that have zero access. They're either underbanked or unbanked. And the fact that you can use actually blockchain technology to give them that financial access,
Right.
it's huge. So that is a big driver of why she's building this business. It's to make a better world for the future.
Fascinating. Well, I want to switch gears back to what we said we were going to talk about, but thank you for that. Okay, so Laya, if you want to just share a little bit more from your vantage point, walk us through how you view the macroeconomic climate right now.
It's a tough market. I mean, I've been in the markets for over 30 years, and I've seen a lot of cycles. I've seen the tequila crisis. Actually, I started with the crash of '87. Tequila crisis, and then the Asian crisis, the Russian crisis, the dot-com bubble, then obviously the great financial crisis, and all of that. But this is like kind of, to me, I've never seen a macro environment like we're seeing today. The fact that last year stocks and bonds went down by 30%, like 20-year treasuries were down 30%, and so was the NASDAQ. Like, when was the last time that happened? And I think a lot of it had to do, obviously, with the global macro picture of high inflation, and people thought it was transitory. It wasn't. And all these central bankers for years, the easy money, like zero cost of money, money flooding everywhere, inflation rampant, and frankly, I don't believe that inflation is going to go down to where people think it's going to go down to 2%. No. I mean, if that were to happen, I think actually long-term inflation rate is going to be closer to 3.5% as opposed to 2.5%, but it's still going to take some hiking. And so with that kind of as background, and then there's a lot of kind of global kind of macro picture supporting that thesis. You look at geopolitically with what's happening with the wars around the world, prices are going to keep rising. With China coming back out after COVID reopening, that could be inflationary. So there are lots of kind of indicators that inflation is still not tamed, and you need to increase the interest rates around the globe. And so with that as kind of background, and then you look at traditional asset classes, and as I mentioned, bonds and stocks were both down last year, public markets. Alternatives were also hurt. I mean, the periods of easy money is gone. So where do you invest, and how do you keep a diversified portfolio, and yet kind of where do you look for those kind of growth opportunities?
Yeah, where are you bullish right now?
Well, I mean, obviously I'm biased, but I think technology, even though it's, you have to look at it as a long-term game, especially in some of the newer kind of areas such as blockchain technology and digital asset, AI, and otherwise. But you've got to think of those as the big growth opportunities that you should invest. Just speaking about blockchain and digital assets, I would not, from an asset allocation point of view, I would not do anything less than 1. 0% allocation is not the right answer, but more than 5% is also not the right answer. It's a nascent industry, it's highly volatile, it still has a lot of growing up to do. But it is, like, the way it's disrupting so many different industries, you would do yourself a disservice of not investing in it. Because by not investing in it, or at least not looking at it, you're making a decision about your existing portfolio, which is going to be disrupted by this new technology.
Right. It's interesting because blockchain, AI, as you mentioned, I think of less as industry and more as really the underlying infrastructure that can be applied to so many different verticals and industries, right? So if you were to think of certain areas in particular where there might be opportunity for those applications.
Right. I think if you look at it, blockchain, for instance, just focusing on that, because that's where kind of my knowledge base is currently, it's really disrupting every single industry. Like, for every single traditional kind of industry, whether it's payment system, whether it's exchanges, whether it's borrowing and lending, whether it's gaming, whether it's art. You see all of those industries there is an alternative in the blockchain space for it. Are they there yet to kind of take the traditional markets out? No, but when you think of it, the S&P 500 financial, just that segment, is about 4.3 trillion in size. The blockchain version of that, DeFi, is only like 45 billion. So just when you think of it, like even if there are a lot of like businesses that could go out of business, like a lot of the newcomers, the leaders will be the future incumbents. So that's why I think that there is that asymmetric return to the upside. I mean, the way we think of it is that by owning a diversified portfolio of all of these kind of blockchain, either technology platforms or the liquid tokens that represent them, you're basically buying a series of out-of-the-money call option into the future with zero expiry. So that kind of hockey stick potential outperformance is what makes it interesting.
So you're saying, and Inger, how about you when you think of the, given the current volatility and economic climate, this particular areas of opportunity for growth and where you're particularly excited right now?
Well, I think first and foremost, I like to keep a balanced portfolio, and I have sort of think of my investable assets as in sort of a matrix. So I've got growth and stable value, and then I've got illiquid assets and liquid assets. So that I have, the illiquid ones would be investments in private equity. My husband's in private equity, so we have some exposure there, venture capital, some of my real estate investments. On the liquid side, I do invest into ETFs, a dividend growth fund or growth fund, and I do invest in individual stocks as well. And cash. It's very important to keep money in cash too.
I'm curious to hear more about your liquid strategy. Obviously, I'm biased, coming from the venture space, and knowing that you yourself are an allocator into newer funds that are up and coming. Presumably, I'm rooting for them as up and coming. This past year has been, even amidst the past couple of years of a global pandemic and economic downturn, venture's been doing quite all right. Seed deals have had higher valuations than ever before, more activity at the seed stage than ever before. What do you anticipate in your venture strategy being like in 2023? Do you think we're going to continue to see a correction that a lot of folks have been preparing for a while?
Yeah, well, I think that, I'm pretty happy with my venture exposure right now. As I may have mentioned, I invested in the Estia fund, which invests in sustainable industries, fintech, healthcare. And then I've also invested in Accrued Diversity Capital, which invests in more fintech, some crypto, and it's data-based companies. So I think that from a VC standpoint, and I think this is one thing we talked about, was that the exits had not been as strong. And I think that founders are looking to take lower valuations now in an opportunity to get an exit rather than having to follow a business plan and go out and raise more money, possibly in a down round, and then to reach cash flow break even. So I think that, so I'm not doing any more venture investing at this stage right now, but I am looking forward to see what these two funds can do.
I was just going to add a couple of comments to that, and I agree with you 100%. I think in the VC space, there was during zero interest rate environment, there was a lot of money that was raised in VC across the board, and not just in tech and fintech. But there's still a lot of dry powder out there. And with what happened last year, which impacted every single risk asset, including venture and others, I think valuations have come down quite a bit. And you're right, the founders didn't want to kind of do down rounds, the second or third round, but they're coming to the realization that they need money, and the cost of money is going up, and they're better off getting that money than not. So I think there are better opportunities for VC investing in general in 23 and beyond. Just in the world of blockchain and crypto, there was about 50 billion that was just recently, last year, raised the last couple of years for VC investing in that space. Only about half of that has been deployed, so there's another 20, 25 billion that's still available. So I think there's going to be interesting opportunities. The problem is that a lot of these big VC funds, like Andreessen Horowitz, they went and raised billions. And I just don't know if the opportunities are of that size. So, and I think they probably are going to invest more in companies that they had already invested in. So like the later stages, like Series C, D, and later, as opposed to seed investing or like Series A or B.
Yeah, what I'm seeing is most certainly the institutional venture funds out there, as they raise more and more, are really looking to not be so stage focused or sector focused, but dabbling into other areas, whereas once upon a time, venture investors were very thesis driven, stayed in their lane, focused on seed if that was their goal. Now moving upstream and even downstream to different stages and sector focuses. And Inger, to your point too, most certainly as founders look to the opportunities to take advantage of the dry powder out there, are doing so more so with convertible notes and safe notes and bridge rounds in order to wait it out until perhaps valuations are back around to what perhaps they might have been a year or two ago. But yet, last year, exit valuations dipped below 100 billion for the first time in almost 10 years? So 2016. So it is an interesting correction that we're seeing, marked by this level of over-preparedness for investors. Yeah.
Actually, we're doing a similar thing in terms of financing. We did our Series A capital raise back in March of 21. We raised, we were just a small group with an idea, a vision, and a half-baked business plan. We raised $33 million of Series A capital at $153 million valuation. And now we're looking to do a second capital raise, but we are being very careful. We put aside our Series B capital raise kind of strategy, and we're looking to do a small kind of bridge to get us through, because we know that it's the right decision to make.
Right, figuring out that runway as it relates to what's going on. And okay, so if we were to talk a little bit more now, switching gears back to where we are here at CVS, Financial Times came out a few weeks ago with their factual list of top MBA programs across the globe, ranking Columbia at number 1. I say factual to emphasize our obviously biased excitement towards it. Talking to both of you, it's very clear that you've had these illustrious careers to date that have involved fascinating pivots, really, right? You each had aha moments that drove you, Inger, to become an operator after an investor for so many years, and then back again, and so forth. And Laya, of course, now with blockchain as your key thesis. How have you leveraged your CVS experience, network, and more in your career to date?
Well, I would say that right out of Columbia, I worked for 2 business school graduates. David Londoner graduated from Columbia Business School, and the associate that worked on our team also worked I went to Columbia Business School. So I think that just the school's just vast reputation from an investment in the investment community is amazing. There are so many, particularly so many Columbia graduates in the New York area. I encountered so many of them as I was interviewing. And the other thing that I would say that I've done, which I would recommend to some of you who are alums, is to try out the Alumni Edge programs for continuing education. I took a course, I did take value investing with Bruce Greenwald when I was here, and I took value investing online during the pandemic in the early stages with Thanos Santos, and I really enjoyed doing individual security analysis once again, and I went back into individual stock picking. I actually backed up the truck on bought Disney, which did really well in from September 20 through 2021, and then had sort of fallen off a cliff more recently with the I'd say he was more of an interim CEO, Bob Chapek, and now we've got Bob Iger going back into running the company. So I'd say that's something that I would encourage everyone to do, because I think Columbia really is, it's a great resource for you to continue to stay engaged with. Another thing that I've become involved with is the Women's Circle. Mm-hmm. And my focus is to help with engagement among alums so that they are taking full advantage of all the resources at the school. And one thing that Laya and I were talking about was I really want to build circles for women in different regions, that you have an opportunity to meet with other female graduates and talk about your professional endeavors, and also your personal balancing your professional and your personal choices. And I'm excited to do that. I just joined in the fall, and we're having another board meeting in April.
That sounds like a wonderful network too to be a part of, and to continue sort of the concentric circles that are CVS alumni bases, right? Mm-hmm. Can't count how many times I've been diligencing a deal and I've just speed dialed an alum who is more of an expert in a given landscape in order to better understand an investment strategy. And how about you, Laya?
It's very similar to what Inger mentioned in terms of her experience. I think I chose Columbia because it was in the city. It was great in finance, and I knew that my career was going to be in finance. So I really do owe it to Columbia for getting me my first big job, which took me through my first revolution at Morgan Stanley. And there are so many great alums from Columbia at Morgan Stanley. I ended up, getting to know them quite well, and not only got hired by the Columbia team at Morgan Stanley, but I got to also interview a lot of great Columbia graduates who recruit them to Morgan Stanley, and some of them are running huge businesses now, including Jay Halleck, who's co-head of fixed income, and obviously James Gorman, our Morgan Stanley CEO. He graduated from Columbia a year before I did, and he obviously has had an illustrious career, and he's, I think, on the board of the governors for the business school. Mm-hmm. But I think that whole kind of access to my career, it was huge, and it has continued, that whole alumni kind of network. But also, I think just the diversity of the student body at Columbia when I joined, it was very international, very diverse, and I think that's one of the big pluses of the university.
100%. Definitely. Great. Well, I think at this point we can open it up to Q&A. So I really appreciate having the opportunity to be the one asking questions, but I'm sure you all have many to share as well. Yes.
This is not the most technical or profound question, but as a marketer, I'm just curious as to how you came up with the name PhotoBall for your company. What does that have to do with investing?
With investing? Oh, well, I'll tell you what PhotoBall is. It's a quick print, quick ship sports memorabilia company. And what we do is we take actual basketballs, footballs, and soccer balls, and there is a panel on each of the balls that's blank. So on a basketball, there's like a white panel. It could be a half panel or a full panel that's left white. And they're manufactured that way. And then what we do is we receive images from our customers. It could be a logo, some text, and we print it onto transfer paper. And then the transfer paper is put onto this printing machine, which is, the plates are curved, and then we heat press the images onto the ball. And they're used for swag. Corporations buy them for, corporate events. But we've also found that individual customers are finding us. We're on Amazon. You just type in like sports memorabilia. We're one of the top sports memorabilia products on Amazon right now. And so that's how we came up with PhotoBall, because we can take photos and put them on balls. Yeah.
Inger, really appreciate you shared the number. Women-funded firms actually have a higher return than men's-funded firms. So my question is really based on your experiences, what would be the main trait or quality or reasons for women's funded firm to be more successful?
Okay, can you repeat that, because I didn't quite understand it? Sorry.
My question is based on your experiences, what make women more successful in being entrepreneurs or running their companies more successful? What are the more important quality for women to be successful entrepreneurs?
Yeah, I think women. I think women need mentors. I think they need, to meet with other women entrepreneurs. I think that's really useful connections to form. And so what I've learned is actually through the angel investing. I think that's where I've been able to get closest to founders. And a lot of them are young women who don't have a lot of mentorship and modeling. And I think that's where, if you can serve on the board of a small company, you really can help that CEO go through like the trials and tribulations of running a business. So I think the more that they can do that, the better.
This is very interesting, thank you. So, intellectually, I understand the idea of balancing and including, let's say, 1%, as you suggested in crypto. But with the fallout at the end of 2022, personally, I'm very jittery about the thought of it. And I'm just wondering from a PR standpoint how the industry is handling that and what your thoughts are on that front.
Thank you for the question. Look, last year was a terrible year for the whole industry, and it left a big black eye on the whole industry. However, having said that, if you think of it, most of the debacle that took place had nothing to do with decentralized finance or with blockchain technology as a technology. It was all centralized finance. It was people organizations that, because either they didn't understand risk return, or they swung for the fences, or they committed what you call the traditional mistake in finance, which was borrowing short, lending long, basically mismatching your assets and liabilities in a massively levered way. And I'm talking about Celsius and FTX and a few others, on a highly volatile asset class. So that's like LTCM, 2.0, 3.0 version, where you mismatch your assets and liabilities. On top of that, you had fraud. In the case of Sam Bankman-Fried, he committed fraud by taking customer money and using it for his own private business. So all of that, and a lot of it had to do with the fact that this is a nascent industry, and lack of regulation, and we welcome regulation. Good regulation is actually good for the business. And those are some of the kinks that will be worked out over the years. You look at just the internet industry, the dot-com bubble, like how many companies were just fake companies that just would put their shingle up and raise money, and then they had no business model underneath it. So a lot of what we're seeing in this industry is what we saw earlier with the internet. We're talking about fraud, like the biggest fraud that ever happened, corporate fraud, was Enron, and who would have thought? So between like lack of experience and bad actors, like Sam Bankman-Fried, doing the wrong business thing, borrow short, lend long, and fraud, and the combination of the two in his case, it really took the industry back a few years. Having said that, the silver lining is that regulators are really looking at this space with a very close eye. 2 years ago, we were all afraid that they're going to shut it down. Today, they're not talking about shutting down the industry, but they're thinking about how to properly legislate and regulate it. I would say the Europeans and people in the Middle East and in Singapore, Asia, Hong Kong, they're farther along in terms of having principle-based regulation and legislation of the industry, because they missed out on Web 1 and 2, and they don't want to miss out on Web 3. The US is a little struggling in the sense that you have the SEC, the CFTC, the OCC, they're all kind of trying to figure out what to do. But the good news is that from a legislative point of view, it's bipartisan. Both sides, they want to keep innovations going, and obviously we have to figure out what's the right way to regulate the industry. I think a lot of the froth has been taken out of the system. Last year was actually a good thing that happened, and it happened much faster than in the traditional world because it is decentralized and it's transparent. It will take some time for people to come back or build the same level of trust, but institutional money, that's where the big money is. I think they were coming in, and now they've kind of put their pencils down. They're coming. We were having a lot of conversations with institutional investors, from pension funds to sovereign wealth funds to large platforms, wealth management platforms. They are kind of starting to think of getting back in because they understand the power of the technology in the long run. Some of them invested in the FTX and Celsiuses of the world, and they got a big black eye, so they're kind of like waiting. But I think if you think of the industry in the long run, it's something that we're very positive on.
I also think as venture investors too, in the more liquid asset class, I mean, when you think of the fact that Sequoia even put out publicly their statement on their investment with FTX, there's this level of transparency that is going to have a higher expectation moving forward. Actually, I'm curious what you're both doing to really dig into the governance of your own personal investments moving forward. What types of questions are you asking around that?
Well, personally, I do that a lot because I came from the world of traditional finance and credit and raising money for asset managers. So a lot of due diligence we do. And also the way we've built our own company at Menai, we have very strict governance across the board. And you look at our board of directors, it's like S&P 500 type board of directors. So governance is very key for me personally as an investor, but also in terms of how we're running our business.
Agreed. Governance is key. I mean, you have to, it's vital.
Yeah, I wonder even if the venture space will start to see boards form at an even earlier stage than they were before. To be seen. Sorry, I know I'm not the one asking questions now. It's the audience. Next, anybody else?
Thank you all for your insights on how you're navigating this current down cycle in the private and public markets. And I'm just curious, having lived past down cycles and past up cycles, for the down cycle in particular, what's similar, what's different, and how is that informing how you're taking action in your business and your investments? Just curious on that multi-cycle perspective.
I think what's different is that, frankly, I've never seen anything like this in the past 30 plus years of my career in finance, where stocks and bonds are down together. And it's not just stocks and public markets, private markets. I mean, if you were to market a lot of these portfolios, they would be down big time too. So I think we have to live with a world where easy money is no longer there, and you have to live with a world where inflation is going to be higher and interest rates are going to be higher. And when you look at it, the fact that the US government has a $31 trillion debt problem, and there's $1.5 trillion basically being added to that every year just in terms of the interest rate cost, that's kind of scary. So that to me is what's really different, and how do you kind of stay afloat, invest in this environment? And I think in a way, like having, obviously we always think, even for my own personal investments, we have my family, we have a diversified approach to our portfolio, but I think in a way, like when we think of it today, you're maybe better off having a barbell strategy where you put most of your money in a safe asset, whether it's US Treasuries or like US Treasuries, and then put 10% of it in some growth opportunity, which could be that moonshot opportunity. I think that could give you a much higher yield on your investment than just like doing the 60-40 portfolio and sprinkle things here and there. So that's kind of my view. I don't know, but Inger, what your thoughts are.
No, I would say that we're pretty conservative and diversified and have a balanced portfolio because this is a very uncertain environment right now. And I mean, I think if we are heading into a recession, which we're not technically there yet, but I would invest in more, industries that are of high need for individuals, like healthcare, consumer staples, information technology, maybe utilities, and that I think I'm getting through some of my ETFs. And I agree with you too. Take a little bit of risk, like in 10% of your portfolio, and then also look at some short-term fixed income assets. I'm not exiting, I'm staying in, but just recognize that you might be up for a bumpy road.
Hi, thank you for your insight so far. We've touched a bit about women getting involved as investors and board members in terms of supporting more diverse founders and diverse portfolios. I have two somewhat related questions on that topic. One is, if you have an operating background, what advice do you have to transition into the VC space where you can apply your skills to a bigger portfolio? And then relatedly, in my own background, I do some work as a board member and advisor to startups, but I find that, bluntly, white male founders are braver to ask me to get involved in that way than the female founders in my life. And so what can we be doing to encourage female founders to actually leverage their networks better to get the right kind of independent board service from the experts in their life if they're not as equally brave? Thank you.
That's a really good question.
Well, while you're thinking, I'm happy to kick off because I did, to your first question, I actually did precisely that. I started in an operating career path in the startup world, and then came to CVS in order to turn to the investing side of the table for that level of pattern recognition, right? In order to be able to helicopter into startups and provide best practices, tips, what to avoid doing, hacks based on seeing what a number of other companies in my portfolio are doing. And what I can say is that that trajectory of going from startup operator to investor is increasingly common in the venture landscape. That said, there's no linear path to venture investing. Find a variety of backgrounds, particularly if your investing strategy requires a level of hyper-domain expertise. But happy to chat more with you there afterwards. And then to your second question, which is a really good one, I do think that, to Inger's point earlier, there's a level of symbiotic mentorship that's required. So it's having more women on cap tables in order to work with the women founders in understanding when and how to pull for those resources around them rather than waiting for a pushed resource upon them. It's funny, in investing, it's often joked that the line, "let me know how I can help," is this empty offer, but really it is up to the founders to understand when to leverage the resources around them the right way. And I think the more that women leaders and women founders connect with each other and learn from each other to when to take advantage of those resources, the better. So perhaps more of these women's circles are required across different industries and asset classes.
Yeah, I echo your point on, being able to build the right kind of team of board members and reach out to your female network to gravitate them and then ask for their help. Like, be specific. We had an earlier, I don't know if you were here, but one of the first sessions, one of the CEOs, she said, look, if you're going to put people on your board, you better be asking them for things.
Right.
Otherwise, it's just like they come to a meeting and then they leave. So
yeah, it's often overlooked that investing is such a two-way street, right? The immediate capital seems so valuable, but the equity that you're giving up is hopefully much, much more valuable in the long term. So sitting in a boardroom is not cheap to the company, and it's up to the company to really make the most of these not so free employees that they have at their fingertips. I think actually that was our last question, right? Okay. Well, thank you so much for all being here, and thank you to these wonderful panelists. I really enjoyed this conversation.
thank you.
Thank you.